you know, with Snap, it's relatively a new company. I mean, it's a startup that just recently listed. Um, it's not really making any money now. For all those who will know, Snap is basically an instant messaging app and also enables people to share images and messages. Now, the margins of Snap, I expect that because I mean, it's still well a very new company. It's basically a startup that just listed. So the margins are declining, and the same thing with Pinterest. Companies early on in their life cycle, the most important thing needs to be considering the path towards profit. Is there a sustainable path towards profitability? Is this company chasing growth? Is it chasing growth and profitability? So let's identify. Net margins have been improving significantly over the past 3 years. Very good. I like that. Now, cost of revenue has been increasing. All right. I don't mind that. All right. Now we have to distinguish with these costs that we're going to analyze. Is it a cost in chasing growth? Is it a cost in chasing growth and profitability? So you're not just going for the sake of profitability. I mean, you're not just going for the sake of growth sake. You're going with a long-term view of profitability. R&D growth. I mean, decrease in 2018, but I mean, it's been uppish in the rest of the following 2 years, 2018, 19, 2020. So 2018, this would be a bit of a cause of concern. I mean, still a new company, should be spending significant R&D, not easy, but okay, could indicate cost control. Maybe they found inefficiencies and they reined them in. R&D as a percentage of revenue, it's significant. Um, I do expect that. Yeah, you know, wow, that's a lot, but okay, it's expected. It's expected. Still new, still chasing growth and profitability, hopefully. Sales and marketing. It's been increasing, but at a downward trend. Average about 28%. Industry average about 25%. However, revenue has been growing at an average rate of 45%. So that is justified. It's basically obtaining above industry revenue growth, even though it's spending above industry sales and marketing. So yeah, that's justified. Now, the revenue growth does justify a lot of this increase in expenditure. You're increasing expenditure, but what I do like is that the company does have a keen eye on not just spending excessively, reining in spending when needed, and eliminating inefficiencies. All right, I like that. It does justify the revenue growth. I like that. Net income has been growing at a bit of a declining rate, and that to me is a bit worrying. You're increasing revenue by a massive factor, but your net income is, you're actually moving away from profitability. So that's a bit scary to me. And it is of course supported by the fact that there's been an explosion in financial risk in the form of interest expense. I mean, interest expense has exploded and has been eating a bit into my net income. So as much as you're controlling costs where you need to, increasing expenditure relative to growth in revenue, you're achieving above industry revenue growth, that's okay. But I'm a bit worried that you're growing revenue at the expense of net income. Because I mean, I would expect that should my revenue be increasing, I don't want to see too much of a significant, which I'm seeing now, decline, backward movement in my net income. Yes, you're improving my margins, but you're still far away from profitability, and decreasing my net income growth just pulls me back even further from profitability. So this worries me a bit. and it's compounded by the fact that there's an increase in interest expenditure. We can argue that, yeah, it's justified because, I'm increasing revenue at a compound rate and an average compound rate of 45%. True, but you're also experiencing a decline. Yeah, your net income is increasing at a compound rate of 31%, but the bigger picture is that it's declining. Your margins are still very far from profitability. So the question is, with negative margins still far from profitability, decreasing net income growth, are you growing for the sake of growing, or are you growing for the sake of profitability? And this points to me that Snap is at this stage just growing for the sake of growth. It values the top line more than the bottom line. And I'm worried. The increased financial risk in the form of interest expense is really eating into my net. It's really eating into Snap's net income. Again, worried. So from a profitability point of view, Snap is not for me moving in the right direction. Return on equity. Wow, nice. Improvement, but still very, very far from returning any significant returns to on shareholder capital. So it's been declining, it's been improving, which is good, but yeah, this cannot tell you really much because Snap is not making any money, and you do expect this, but yeah, it just shows you how risky it is to invest in a company that's not making any money. That it will not give you any returns, it will in fact destroy those returns. Looking at the balance sheet, very strong, very stable, driven mainly by the cash. Now that cash mainly comes from the debt that Snap has been taking up because it's not making any cash from its operations. So that cash is driven mainly by the increasing debt. All right, good current ratio, happy, solid, liquid balance sheet. Current liquid assets exceed current liquid liabilities by a factor of 5. All right. However, the debt to equity worries me a bit because you're adding a significant amount of credit risk. All right. I understand. Snap is still growing, so I'm not gonna expect um, positive margins or positive ROEs. I'm expecting improvement and path towards profitability, but this not only adds financial risk on my balance sheet, it also adds financial risk on my profitability because it eats into my margins and makes the path towards profitability, as indicated by the growth in net income, that much harder. Not happy with this, considering Snap is burning through cash. You will see I'm reading the the balance sheet ratios and the cash ratios together, because the increase in debt, I know, is due to the fact that the company is either wants to borrow more to strengthen it does have enough cash, it does make enough cash, but just wants to strengthen its position. But Snap does not make enough cash. I mean, the cash from operations has been improving. All right, sufficiency of cash flow has been improving, but it's still negative. Now this shows me that Snap is burning through cash. It doesn't have enough cash to fund operations, so it has to borrow more. All right, at a point where now debt is 116% of net income. I'm sorry, 100% of net worth. Sorry for that. 116% of net worth. Now that to me is a bit scary. That to me is a bit scary. Considering the company is not making any cash. Yeah, the margins are improving, but it's still far away from generating cash from its operations. So this just highlights how risky this company is. Cash from operations margin, it's not making any cash from operations, it's actually losing cash. So for every dollar of revenue it generates, it's losing 7 cents. in terms of cash. So in a sense. Now this means obviously we'll not have sufficient cash available. I mean, it means it doesn't make sufficient cash. And that explains why it has to borrow more, and that explains why so much interest are eating into margins. So this tells me, the debt to equity and the cash margins and the sufficient cash flow ratios tell me that this company, Snap, it's really burning through cash. I mean, my goodness, it's burning through cash at an alarming rate. I mean, it's getting there in terms of profitability, but it's still quite far. You know, um, the market, the social media ad-based platform market, it's saturated, and that is why you've got other companies diversifying. Snap, all of its income basically comes from its ad-based platform, and it's hard to see how it's gonna. I know that there has been this push that, oh no, Snap will be a beneficiary of the metaverse. I don't see that yet. It's not making any money from its current operations. So, how will it master the metaverse? So it's losing money at a rapid pace, it's borrowing also at a rapid pace. That adds to the risk of it. And yes, high risk, high reward. Many would look at Snap and say, oh, no, no, but it's very close towards profitability. No, no, no. Pinterest is closer to profitability than Snap. And Pinterest is trading at a price to sales of less than Snap. So whoa, so whoa, so whoa, and I believe Pinterest is what 20. Yeah, Pinterest is what in the early 20s, and Snap is in the late, almost 30. It's trading at 29. But so for me, the risk is too high. The profitability scares me because it shows me that Snap is still far away from profitability, and it's not necessarily growing for the sake of profitability. It's rather growing for the sake of growth. It does have liquidity, but that liquidity is mainly because it borrowed a lot of money, and that adds a lot of financial risk for me. It's not making any money. It's competing in a very, 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 very competitive market. So it's a bit of a risky stock for me. It's too risky for me. It's above my risk tolerance. Some investors will look at it and say, "Oh no, for me, it's a good company, and yes, it's within your risk tolerance. But for me, it's not within my risk tolerance." Again, it's not making any money, so it's trading at a price per sale. So for each dollar of sales Snap generates, you're paying $29 each dollar of sales Snap generates. That is very high. I mean, Twitter is currently trading at a price sale, and it's only like 11, and it's profitable in essence. So, and it actually does make money from its operations, and it does have a positive sufficiency of cash flow ratio. So, I don't get why Snap is trading at multiple high that of Twitter and Pinterest, considering Pinterest is closer towards profitability, and Twitter, bar its dog show of financial results, it is trading. It's actually a profitable company. Now, I know some investors will, say, "Oh no, no, but on an adjusted EBITDA, on an EBITDA basis, Snap is profitable," and I don't like using that. I don't like using adjusted EBITDA or adjusted EBITDA or EBITDA to determine if a company is profitable. No, 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 no. EBITDA and adjusted EBITDA is more for you want to value a company, and even at the end of it all, you still include expenses towards capital assets as well as debt, as well taking into account debt and of course cash on hand. But for me, Snap is too risky, and it's not profitable. So you cannot. So adjusted EBITDA for me are a circus act that people perform to justify why an unprofitable company is actually profitable. It's just you bending over backwards and convincing yourself that an unprofitable company is actually profitable. No, 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 no. We're looking at the finance, net income. How much net income does it? How much net income hits the income statement? That is profitable. So I don't want to use that. That is a lie. That is an fallacy in my view, an imagination fairy tale story that you tell yourself to convince yourself that an unprofitable company is actually profitable. Now, my problem with Snap is its valuation. I mean, it has a lot of risk, which I wouldn't take, but its valuation is also a major problem for me. It's trading too expensive.